experience of being with that. So, as I said, it's good to hear things as you again as you progress, because you hear them explained differently and also from different people. So it's great. I think hopefully that after I've explained it, that'll put all the pieces that might have been missing from make that videos for us. All right, so we're looking at this simple consumer consumption savings decision. 2 periods, simple in the sense that it's just 2 periods. Right, and we already saw the dramatic effect, we've gone through here the problems of the dramatic effect that credit constraints can have. Right, and if we think about an aggregate consumption function, it's going to reflect both these types of agents. So now I want to think, move a little bit deeper into the asset pricing with a financial markets perspective, and look at how we price assets. Looking at from an arbitrage-free perspective, what we can say about efficiency of financial markets, and pluses and minuses, say, of globalization and liberalization. And one of the big minuses, of course, is then financial crises. Okay, so arbitrage-free pricing. We've already thought about arbitrage as some examples when we were comparing the price of gold here, price of gold in Ho Chi Minh City, right? Why that should be the same. Right? We've thought about the exchange rate, right? And how the exchange rate has to adjust. Think about gold between here and Bhutan was the example, or think about bonds between investors deciding between bonds in Vietnam and bonds in Bhutan. Right? When we think about the decision to invest your resources into a nominal asset, like a government bond, or investing your resources into a real asset. So maybe I have tools and equipment, and I can use them to produce things. Or I can take these tools and equipment and I can sell them, get money, buy a bond, and in a year from now, have more money. When should I choose which? We've already seen this come up in an answer for the problem set, the Fisher equation. Right, it's going to relate nominal and real interest rates. And we can derive the Fisher equation through a no arbitrage argument. And so hopefully when you're seeing this, there's going to be kind of like somewhat of a repetition, right? This tool, no arbitrage, right? It comes up a lot in financial marketing, and we've talked again and again about the intuition for why. Because if there is an arbitrage opportunity, that means there's free money lying around. Then who's going to say no to free money? We'll see later that there might be something that looks like arbitrage but isn't, and that's going to be speculation. And we'll talk about that a little bit later. So let's look here at another example of arbitrage. So we have one good. If I have used the real interest rate, a year from now I'll have 1 plus RT goods. So the way I like to think about this is to make sense. How do I invest a real good in a real market? I like to, again, let's say I have tools and machines. I can use these tools and machines to make new tools. So if I start with 100 tools, after a year I will have 1 plus RT times 100 tools. Right? During the course of this year, I use these tools to make new tools. Some of my new tools might break, and put it all together. Maybe after a year, I'll have 103 tools. I start with my 100 tools. And that would be a 3% real interest rate. Right? Alternatively, I can take this good, I can sell it for money, in this case euros. I can buy a bond over the course of the year that will pay me then the nominal interest rate in euros. And now I want to compare the two. The difficulty in comparing these two is I have euros in 1 year and tools in 1 year. I know how tools today and euros today are related. That's the price today. My co-author's working. But I don't know necessarily what the relationship between money and tools is going to be in a year. The best I can do is form expectations about that. So the expected price is important. Right? And this is important when we think about comparing things through time. When we use an arbitrage argument, we're always going to end up having to take care of expectations because we don't know the future. So we have no arbitrage in expectation. It might turn out to be after the fact. Right? If the actual price level tomorrow turns out to be higher than we'd expected, this would mean that buying the bonds turned out to be a worse case, right? A worse decision. If the price level tomorrow turns out to be lower than we expected, then the real return on these bonds will end up being better than the tools. Right? So we don't know for certain how it's going to turn out. But before the fact, before we start investing, right, we're going to be indifferent between the two investments based on our expectations of the price of the tools next period. Right? And it's exactly this difference, ex post, after the fact, if we compare the real interest rate that we see after the year with here the actual inflation. This is one plus RT is equal to 1 plus IT times PT over PT plus 1E. So we can write this as 1 plus IT times PT over PT plus 1E. And I would like to replace PT plus 1E over PT with, in this is the best mathematical trick ever. This is amazing. I'm going to subtract 1
Plus 1.
and add 1. Huh? Pretty amazing, huh? And bring that 1 out front, and I have PT plus 1E over PT minus 1. And now I can combine that minus 1 there. And I get PT plus 1E minus PT. This is the expected change in prices relative to the price level day, so it's the expected rate of change in prices. This is expected inflation. Right, and so now I want to plug the inverse up here, and so I get 1 plus t times 1 over 1 plus I t plus 1, right? Are we good? Efficient. Now, this other variant that we can think of is after the fact. That's what ex post is Latin. In most countries in Europe, when we want to sound really fancy and educated, we try to find a Latin expression. Let's use a language from 2,000 years ago. Then we sound very. And so ex post means ex post facto, after the fact, afterwards. In hindsight. So a year from now, we can look back and see how the price level actually developed, and to compare this to the inflation rate that actually manifested. Right? And then I just thought, in the thought experience, it turned out to be higher or lower than we expected, then one or the other investment might have turned out to have been the better investment. But that's after the fact. Right? Remember my horribly embarrassing story about Bitcoin? After the fact, I should have bought Bitcoin, right? But from my perspective then, I think from my expectation, right, it was a sound decision. Just after the fact, I really wish I would have made a different decision. So usually what we want to think about in economics, we talk about the ex ante decision. We're not so much interested in evaluating our decisions after the fact, but understanding how to make the best decision in the first place. Right? And we can't make decisions today conditional on knowing the future, because we simply don't know the future. So what matters for our consumption investment decisions is this before the fact, ex ante facto, so before the fact. Now, if we have certainty, so when we're thinking about this consumption savings model, we turned off uncertainty. We knew what our income was going to be the next period. Then, of course, there's no difference between what we expect and what actually happens, because if there's no uncertainty, those two things are by definition the same. Of course, in reality, they're not, right? They will typically differ in a world with uncertainty, which is where we live. So when we say the real interest rate, we almost always mean this interest rate with expected inflation. All right, how about comparing bonds of different maturities? So now we've thought about comparing real bonds and nominal bonds. Right? Real investments, nominal investments, investments in one currency versus investments in a different currency. How about we compare a short-term investment versus a long-term investment? And a theory based on this no arbitrage argument tells us that a long-term investment is going to give you a return that should equal the average of expected future short-term investments. This comes again from no arbitrage price. All right, so let's think about this. Let's think about RT is going to be the interest rate at time t for a bond n periods that's going to mature at n periods in the future. So RT1 would be the 1 period return today. RT2 would be the 2 period interest rate today. And the expectations hypothesis tells us that an investor is going to be indifferent between investing in a 2-period bond and a 1-period bond if the return on the 2-period bond is equal to the return that I would get if I buy a 1-period bond today. After that year, the 1-period bond pays out, and I buy another 1-year bond. So then I have 2 1-year bonds back to back. 2 years of investment, and I compared that investment with simply buying a 2-year bond up front. Those two things should be the same in expectation. If they're not, both of them are about investing money today and getting money in 2 years. one of the two offers me a higher rate, then I would prefer that one. Right? So it tells us we have this is important. Here, and most of the time in economics and macro, we talk about the interest rates as expressed in annualized terms. Right? So if I say the 10-year bond has a 5% interest rate, what I mean is not that over the course of these 10 years you'll earn 5%, but the return is a 5% per year return. Yeah? Right? That's a subtle difference. And you see the difference here. Right? If it were expressed in an annualized manner, then it would be this square here. Right? So what's happens here is I buy a 2-year bond, say I buy X year of this 2-year bond. Right? And over the course of this, it says that the return of R2, and it pays me R2 the first year and R2 the second year, which is why I multiply 1 plus R2 with 1 plus R2, or 1 plus R2 squared. So that's how I take the annualized 2-year return to give me the total return over the 2 years. Let me say that again, it's kind of confusing. Huh? R2T is the annualized, so expressed in terms of the 1-year return of a 2-year bond. So if I want to figure out my total return over the course of 2 years, I take the annualized 2-year return and accumulate it twice for each year. Right? It'll make sense if it's still not clear, then it'll make sense in just a second when we think about what happens with the 1-year bond. The alternative investment that I'm thinking about is I'm going to buy a 1-year bond. So I'm going to take my X euros. I'm going to buy a 1-year bond. After 1 year, I get my X euros back plus the return on my X euros. And I'm going to take that total amount of money now and invest it again in a new 1-year bond. Right? And well, the return on a 1-year bond next year is going to be R1 because it's the 1-year return. But it's not the return today, not R1T, but it's the 1-year return next year. And of course, the difficulty here is I don't know what interest rates are going to be in a year. Right? So the best I can do is form expectations. The 2-year bond, now let's go back to the 2-year bond, it has the return for the first year is 1 plus R2T, that's the annualized 2-year bond return. And then for the second year, there's no expectation, there's no uncertainty. That's the cool thing, the advantage of the second-year bond. We've locked in the return that we know today. Next year, we're also guaranteed to get that same interest rate, R2T, the annualized return of the 2-year bond from today. All right. Now, we can take logs of both sides. It's useful just to see for a second. So let's write it out here. So we have 1 plus R2T, 1 plus R2T. Annualized return of 2-year bond. Return, so it's the gross return. Principal plus interest, gross return in first year. Gross return in the second year. This has to be equal to Return, in this case, it's already, doesn't have to annualize because it is annual.
R2
Turn
rồi bên đây 1
of-
cộng R2 này.
1 year bond.
2 năm mà mỗi năm
Okay.
nó đều như vậy.
This gives us
Thầy
không,
viết
ok. Nhân lại
gross
thì
return.
là bằng bình đó chị.
annual của
Cái
2
cái
năm.
bình đó là bằng cái
And is the handwriting or?
ờ,
My handwriting is. So I tried really hard, but I failed one class, only one class in all of my school, and this was in 2nd and 3rd grade. Yeah, 2nd and 3rd grade, handwriting class. We had to practice our hand, and I had to stay after school and sit at my desk and practice my handwriting in front of my teacher. I don't know if it worked out, but so that's been annualized return. Your bond today. I'm going to get a different marker that might help. Gross returned. And a blue cap, it was London. In the first year, one plus t plus one. This is the expected return of 1 year bond next year. Ooh, look at that.
Wow.
Fine, delicate letters. Huh? Gross. Return in the second. Alright, so now you see we're comparing the same thing. It's the return year by year over 2 years. Alright, but now we can write, so we have 1 plus RT2, this expression squared, equal to 1 plus RT1, 1 plus ETR1, E plus 1. And if I take the log, natural logarithm is awesome. It's amazing because it turns multiplication into addition and exponentiation into multiplication. Right? It's a magic tool. All right, so multiplication into addition. So log 1 plus RT1 plus log of 1 plus ET RT plus 1. Here then, we get 2 times the log of 1 plus RT2. And we looked at a Taylor series, right, a first order approximation. If you do that with the logarithm, right, around some point x bar. So function at the point x bar plus the derivative, 1 over 1 plus evaluated at the point x bar times x minus x bar would give us the first order approximation of the logarithm. And if x bar is equal to 0, so if we approximate around the point of x0, we get the log of 1 plus 1 times x minus 0 is equal to 0, so we simply get x. And this approximation is a good approximation, right? So we'll simply write 1 plus x equals x, or is approximately equal to x, if x is close to 0. Right, so then we would write 2 times r 2t is equal to r 1t plus the expectation of r1 t plus 1, and we get the expression that we have in the slide here. And what this tells us is that the 2-period rate is the average of the current 1-period rate and the expected 1-period rate next period. And there's something really kind of cool about this, because we can go to financial markets, and if we have a 1-period bond in a country and a 2-period bond for a country that are both being traded at the same time, we can back out, we can impute what financial markets must think the interest rate next period is going to be. They're telling us, they're revealing what they believe. Financial markets are giving up their information. By the fact that they're trading, and they're trading on their beliefs, their expectations, and we have lots of people trading who are all trying to not make a mistake in order to make the most amount of money, right? No arbitrage here. If we observe these two rates on a market, we're learning something about what everyone with the financial market as a whole thinks about interest rates next period. Right? And so we can think about evaluating, for example, credibility of the statement by a central bank. All right. So we're watching the stock market in a country. Let's go. Let's always pick on a different country. We're in Thailand, you know? And the Thai central bank says next year we're going to lower interest rates. Right? And we go to financial markets and we watch and we see that the 2-year rate relative to the 1-year rate doesn't go down to what it was before. Well, this means financial markets don't believe that this rate is going to go down next year. But the central bank just said, well, okay, the central bank said that, but apparently financial markets don't believe it's going to happen. That's pretty amazing. They've revealed they might know something that we don't know, or maybe the Thai central bank has lost credibility. You know? There are many explanations behind why they might believe something, but in any case, they've revealed what they believe. You know? And that's a very valuable thing. And that's why financial markets, for example, are something that we, right, liberalizing financial markets, let financial markets trade without interference. The advantage of that is when they trade without interference, they're going to be free to trade on their beliefs, and they will then reveal their beliefs. Right? And the reason why that's useful is that, you know, person 1 might know something about Thailand, person 2 might know something different. Right? We have lots of different people that know different parts of Thailand, different parts of the Thai economy. But when they all get together, sort of summarizing all of their information, is what's going to give us then these different interest rates. So somehow this expectation coming from financial markets is representing the best information, all of the information perhaps available to financial markets. That's what we didn't have to ask these people. It would be expensive. If you're a government, we could have the central office of figuring out people's interest rate expectations. And every day, we could call up every person in the Thai economy and think about their expectations to figure out whether the central bank's action was credible or not. That would be very expensive, right? Very difficult. This happens instantaneously because of the way they trade. Right? So we get free information, right, by letting markets trade. Perhaps. We're going to come to some criticism of this later. Now, this doesn't just hold for 1 versus 2 periods, this will hold for 1 versus n periods. All right, so if we have, say, a 10-year bond, right, well, that's going to give us, it's going to be the average of 1 period or 1 year returns over the next 10 years. Right, so if you want to figure out what markets think about the expected interest rate in 3 years, right? We can then, for example, let's take then 1 plus RT3 cubed, and 1 plus RT1, 1 plus ET R1 T plus 1, 1 plus ET R T plus 2, 1. Math here, we get then 3 RT3 equals RT1 plus ET R1 T plus 1 plus ET R2 T plus 2. And if we take this and subtract that from there, we get then that we can figure out what markets believe the 1-year interest rate is going to be in 2 years by calculating that difference. If we have 3-year and 2-year bonds traded on the market, and we take their difference weighted by their maturities, that's going to give us the market's expectations of the 1-year return in 2 years from that. So we can now back out the maturity, or back out the expectations of interest rates at any point in time in the future, so long as we have enough different bonds being traded. And we can summarize all of this in an object that's called the yield curve. Right, so the yield curve, we can simply map these expected the yield curve will just map the different maturities that we observe. So yield curve and so if we see R, let's do R1, R2, and R3. Well, the fact that we see a difference R2 is equal to the average RT1 if financial markets believed that interest rates were going to stay constant, that RT1 1t plus 1 was expected to be equal to RT1, then this average would simply be RT1. We would have a flat yield curve. The fact that we see this yield going up relative to RT1 means that we believe the interest rate next period is going to be higher. Likewise here, this is equal again to the average of short-term, the average of expectations of short-term interest rates in the future. Here we have a flat component, so we don't expect there to be a change in the interest rates further out. So upward sloping yield curve suggests rising future or expected future short rates, downward sloping falling short-term rates. Okay, so we can so the yield curve is a very useful object. Look at ECB has a kind of some different ways that we can calculate it. Okay, let's use the R yield. Let's look at so we have here in January of 2020, right, the European Union was slowly coming out of the European debt crisis that had happened several years before. The United States had been raising interest rates. Right, we already had lift off in the United States for a couple of years. Interest rates were, I think, about 2%, 3% in the United States. Right? And it looked like Europe was about to start raising its interest rates. Right? And so we have some evidence here, right, in an upward sloping yield curve. Then, May of 2020, is that it? One more. Yesterday we have first interest rates were dropped, right, with COVID lockdowns, but people then expected, okay, we're going to come out of it real quickly. Then this orange is May, and we see the expectations are now, for the next several years, interest rates are going to continue to go down, to become even further negative. This we thought maybe this COVID real quick over. Maybe it's going to be painful, but it's not going to last very long. as the summer started to approach, it became clear that, you know what, this might take a while. And you can see that part here in financial markets, they're expecting interest rates to continue to go down. So you can do all sorts of very interesting narratives. So before the financial crisis, 2007, right? It's like the ECB's interest rate was somewhere around 3.8%, and people more or less expected it was going to stay that way. 2008, the financial crisis hadn't fully hit yet, but there's lots of bad news from the United States. The United States is starting to drop interest rates, as we saw, and markets were expecting interest rates to go down over the next couple of years. So we saw. Hold up. So if we think around 2008, in Europe, interest rates were still where they had been for a while. They held constant. They weren't rising anymore. But the central bank in the United States, in response to the unfolding financial crisis, had already started to lower its interest rates and to do so very aggressively. And so even though the short-term interest rates were constant, financial markets said, you know what? I guess one way to interpret it is financial markets and looking at what's going on in the bond markets, looking out at what's happening in the United States, I think interest rates are going to go down. And we see that they are pricing in, perhaps the terminology, a 75 basis points, so a 3/4 percentage point interest rate decrease. Which means if the ECB now were to come out and say, in a year from now, over the course of the next year, we plan to lower interest rates by 75 basis points, do you know what would happen? Nothing. Why? Because that's already what markets were expecting. That's already, they'd already priced it in. Right? Interest rates are doing exactly then what they were expecting them to do. It's only going to be things that differ from surprises, or from expectations, only surprises that are going to cause changes here. Right? Remember the surprise inflation boosting the economy. Think about the Phillips curve from a couple of days ago we were talking about. Right, so we have a very straightforward and powerful instrument to see into the future, or to see what financial markets think the future is most likely going to be. All right, but there's some critiques here. No arbitrage tells us the only thing you care about is expected return. If I buy a 2-year bond, what I'm saying is that here's my money. I'm not going to get it back for 2 years. When I buy this bond, I can, at the end of that next year, buy another 1-year bond, but I could also do something else with that money if I wanted to. Oh, flexible, inflexible. there's something attractive about having flexibility, right? There's less risk. If things change, you can change your mind. You know? Right, so imagine at the end of 1 year, you bought, it's 2007, and you bought Greek bonds, or 2008, and that's 2009 Greek bonds, and the markets are convinced that Greece is going to default on its loans. So nobody wants to buy Greek bonds anymore. You can't even resell this on the market. You're stuck. You gave the Greek government your money. You're stuck with it. Here, okay, when I was originally planning, I was planning on buying Greek bonds again the next year, but not anymore, and I don't have to. I can do something different. This is in some sense riskier. You have a risk involved because you don't have the flexibility. You don't have the option of being able to change your mind or to choose a different investment strategy. Right? So if someone's gonna say, you need to give me your money for 2 years, and you're not gonna see a penny of it for 2 years. 2 years is a long time. I'm going to take the interest rates and my expected interest rates here, and I'm going to add a little bit on top of risk premium. You have to pay me a little bit extra. We can think of some, there's some, right, yeah. And this risk thing is going to show up, it's going to show up again. There's, I'm going to give you an example. Do you know who Friedrich Merz is? He's the Chancellor of Germany, right? So let's pretend Friedrich Merz was here, standing next to me, and Friedrich Merz offers you a bond. Friedrich Merz says, give Germany your money. We'll promise you a 3% interest rate. Okay? And then I stand next to him and say, hi, I'm Alex Meyer-Goda, Professor Meyer-Goda. I'll also give you a 3% interest rate. Who are you going to choose? Well, hopefully, you like me and I'm nice and all of that, but some individual person or the entirety of the German government? There's something that's a little more trustworthy, a little more safe with that. So if I'm going to convince you to give me your money instead of the German government, I might have to offer you a little bit more. Right? How much more? That's what we call the risk premium, and that's measuring your perceived risk of lending me the money relative to, say, the German government. Right? So something we can also look at, it's a spread. So if we look at spreads, this is the OAT is a French bond, right? And what this is doing is it's comparing, different bonds from different countries of the same maturity, that's in the same currency, right? We thought yesterday about why we can have different interest rates in different countries because there might be expected appreciation or expected depreciation, right? You have the return of the currency increasing in value. Between Germany and France, there's no such thing. The French euro can't appreciate or depreciate relative to the German euro because it's all just the euro. So if we look at bonds, let me find a different picture. Let's see, I like that picture. So this spread means that the French government needs to pay 81 basis points, or 0.81 percentage points more than the German government. Alright, so remember, Friedrich Merz was asking for 2.65%, like the German government. And I would have had to pay a little bit more. Macron, right, France has to pay almost 1 percentage point more. Right, there's no currency risk, but there's some risk premium. Right? That it's a credibility, or maybe there's something special about the German bond. Maybe it's considered it has a value in terms of trading for other people. Like, I always know I'll be able to trade that. So what do I mean? So like, if you're traveling around the world, you might want to have some cash just in case. If I'm in Africa, I'm not sure when I go to change money if they'll be able to change Vietnamese dong. When I'm in right at a street corner in Malawi, I don't know, right? So if I'm traveling through Africa and I want to have different countries and I want to have some cash that I can change just in case, right? Which currency would you choose?
Dollars.
Yeah, dollars. You take the dollars. Maybe the euro, right? Maybe the yen. But that's about it, right? There's a extra use of the dollar, so that you know that it's the world's reserve currency. And the German bond, in terms of all the bonds in Europe, has this sort of character, right? We always know that always will find someone who will buy the Gesundheit, the German bond for me. Right? I might explain what there's the difference there. Or maybe perhaps now you see some news. Let's see. Right, this seems to, wow, this went up. This spread was at 66 basis points a couple weeks ago. It is now gone up by 20 basis points, or 0.2 percentage points more. Something happened. Maybe something happened in France, right? That people were worried about. Has anyone seen any news about France recently?
The ministry.
Yeah. Another government collapse. Oh, government collapse. They're the people in charge of the money and the taxes and the government bonds. I don't know. Right? Maybe a little less safe than before. If France wants more money, they have to pay a little bit more than what just an expectations, no arbitrage would imply. So we found a way to price assets with our consumption savings model. We were looking at marginal utility from consumption at different points in time. We had our now I'm going to add in expectations. We were doing the model without uncertainty. write this as and this would be consumption-based, preference-based asset price. We have, write this as this capital R is the gross, so including the principal. so there's a mistake in here, it's just driving me crazy. Let's figure out how to fix it. So we can do this. Do this together. So let's say I buy X euros today. I have X euros today that I want to invest. And I'm going to measure the price of the bond. This would give me then I'm just going to buy one bond today. It costs me this many euros. This would be euros per bond. Bond. One bond. I could have otherwise give me the amount of consumption that I'm giving up, that's the price level. So price is euros per unit consumption basket. The inverse gives me then consumption basket per unit. And this is the utility that I lose. Alright, discount that, expected value. So this gives me the number of bonds. One bond. I have this many this rate, then I have principal bond, and this is the same price per bond. Has to be equal to 1 minute to mature. I'm gonna just so I can fix this maybe a little cleaner tonight. I don't like it. We have so we're gonna price the bond. We value this, all the payouts. This RT includes inflation and change the price of the bond, so it's a composite rate. I'm gonna fix that tonight to make it a little more clear. Using the stochastic discount factor. So we have from our consumption Euler equation is just the value to us of the consumption that we're giving up and we're gaining. Why? Why is this important? Well, sometimes it might be that something that's going to pay out a lot in the future, or something that's going to pay out a lot in 5 years, is not that valuable to us. Let me give you an example. So if there's a bond, you lock in your money for the next 50 years. You're only going to see a payout in 50 years. Now, hopefully not. Things can always happen, but you're probably all going to be around in 50 years, right? So you can attach some value to that, right? There's a lot of your money's tied up, and there's a risk that there is something that happens, and there's no flexibility. But something that's going to give you a promise payout in 50 years might be useful. I look at myself, 50 years from now, I'm probably not going to be here, Right? So I'm not going to value that. So payouts at a certain time are important. Imagine something that pays out let's say just to make the calculations easy, with a 50% probability, you have high marginal utility tomorrow. Let's say you're hungry tomorrow. Asset 1 gives you a free meal if you're hungry, and nothing otherwise. Asset 2 gives you a free meal if you're not hungry and nothing otherwise. The average payout of this asset is 1/2 a meal, right? The 50% probability you're hungry, you get a meal. 50% probability you're not hungry, and so you don't get a meal. Asset 2, 50% probability you're not hungry, so you get a meal. And 50% probability you're hungry, and you don't get a meal. Both these assets have the same expected return, expected payout, 1/2 a meal. Which of these two do you think you would rather have? Well, obviously, the one that gives me a free meal when I'm hungry. What am I going to do with a free meal when I'm not hungry? Right? It's not just the expected return, it's how it interacts with our preferences. So it's about also the correlation between the return and our utility. So if we're hungry tomorrow, marginal utility from consumption is high, and if that's when we get the high payout, right, they're positively correlated. If when we're hungry, this has a low payout, then they're negatively correlated. So this pricing with this this pricing kernel is going to capture how valuable different payouts at different times for us are. And you can go beyond, of course, like silly examples like getting a free meal when you're hungry. Imagine buying an asset that fixes your car if it gets broken. That's insurance. That's what insurance is. Insurance is an asset that pays out when you need it most. And for those assets, you don't have to pay me something extra. I pay something extra. No? It's a negative risk premium. It's an insurance premium. Right? And so we have in these correlation terms this sort of insurance component going on, but we can approximate if this stochastic discount factor, this M, this pricing kernel, if it's constant, we get then the same expression. And we can then determine any difference between these two as a form of risk premium. In bond markets, when the bonds have different maturities, this risk premium often has a specific name, and it's called the term premium. Let this be the term. And part of the reason why it also captures this compensation for holding a longer bond, right? So for holding onto something for a longer term, the term premium. Right? Under the expectations hypothesis, this is zero. Right? So by construction, the yield curve reflects only expectations about future interest rates. Right? If we assume the stochastic discount factor is constant, what we're doing is we're turning off risk premium of the term premium. Then we get to the same expression. Right, so in reality, however, the yield curve reflects both expectations about future interest rates and risk compensations. So if we go back to current interest rate. Right, the current yield curve, we would on average expect a slightly upward sloping yield curve because the longer you're holding the bonds, right, the longer the term is that your money is tied up. So there should be just some extra compensation there always for having your money bound for a longer term. So if we see in other words, we see a slightly upward sloping yield curve like this does not mean that we expect interest rates to go up. No? This could simply be reflecting the fact that we have a higher and higher term premium, risk premium that we demand for having our money tied up for a longer period of time. But when we have in September of 2023, we had an inverse yield curve. I know. Here it's obvious we must be thinking that interest rates are going to be coming down. And in September of 2022, right, we were coming out of the COVID crisis, inflation was picking up, we had strong expectations of interest rates rising. Right? But what we see now, this it's dipping down a little bit, but it's just a small, gentle rise. This might just be the term premium that's adding for the slightly upward slope. Okay, so let's calculate. So let's think about calculating this risk premium. So if we have price and then the resale, a dividend resale return. right, so it's up here. I'll fix that tonight. It's messed up. Okay. So price should be equal to our valuation. So that's going to be this pricing kernel times the dividend and the resale price. So what we give up today, that's the price for getting a bond, and what we get is the dividend or the asset, what it pays out, and the price that we get from reselling it. Now we can compare this to a bond that has no risk. There's no such thing as no risk, but you can think of something close. Maybe the German bond. The US bond is frequently considered close to being a risk-free bond. Take a bigger picture, of course, they're not risk-free. Theoretically, we can think of a bond where the return is guaranteed. Nothing can happen. In most, think of Greece in the financial crisis. Beforehand, they had promised a return, but they defaulted on their loans. Argentina has had bonds where they've defaulted on, so they didn't pay what they promised. It could happen. We could look at the maybe implied risk premium with U.S. bonds default risk. There have been times when the United States was close to not making some interest payments, or who knows what's going on. So there might be some risk, but theoretically, there's going to be some bond that there's no state of the world, nothing could ever happen that would make it default or not pay out. So then we can pull it out of this expectation, right? It gives us, it's going to pay out 2%, so this would be 1.02, no matter what. No matter what, right? No matter what Israel does, no matter what China does, no matter what Trump does, no matter what happens in Greece, no matter what happens in Malawi or Bhutan, even if an asteroid comes, there's no state of the world where it's not going to pay out the 2%. It's risk-free. It's a useful construction because mathematically it's a useful construction. Right, and what we can do, we can now use the inverse of this risk-free rate. Right? This is why it's so useful. It tells us what the expected value is on the market of this stochastic discount factor, this pricing curve. It's going to be equal to the inverse of the risk-free rate. So we can now write the price of some asset, and instead of the expectation of the product, we can write it as the product of the expectations plus a covariance term. And we replace the expectation of the pricing kernel with the inverse of the risk-free rate. Right, so what is this giving us here? Right, we have the price of a bond is going to be higher, the higher its expected return is relative to risk-free rate. Okay, I guess that makes sense. Something that on average is going to pay out more is going to be more valuable, have a higher price, but the price will be even higher if the payout is correlated with our pricing kernel. If it gives us the free meal when we're hungry, it's going to have a higher price. Or more, right? It's an insurance object. We're happy to pay more for something that pays out exactly when we need it. And sure, I'd be willing to buy the asset that pays me out a meal when I'm not hungry. Why? Because I could sell it to one of you. I mean, it's going to take me a while, and there's some risk because you might not want it, and I'd have to sell it for a discount. But it's still worth something. It's not worth as much as when I can consume it directly when I'm hungry, but it's still worth something. And the difference between this payout, this average expected payout, is in that case going to be deducted downward. It's a risky asset. It's paying out exactly when I don't need it. Right? I'm going to have to do something with it, talk to one of you, maybe. So I'm going to value it lower than its average or expected payout term. So this risk premium is going to be higher for assets with a large negative covariance factor with this stochastic discount factor. Right, so it's not volatility alone that's going to generate a higher risk premium. Right, so something's not necessarily riskier, right, because it's something that can pay out 101 versus 99 euros, so an average payout of 100, or something that pays 110 and 90, a higher variance with the average payout. That's we might prefer we're going to prefer the thing that has a lower variance, right? But a lot of these risk premium, it's not just the level of variance, it's this correlation. Does it pay out high when I need it, or does it pay out high when I don't need it? Okay, and we can now compare the excess return, so the difference between the return on a risky asset and the risk-free asset. Bring this, combining this with the expressions we have out here, the expected excess return is going to be equal to the negative covariance. Right? So it's going to generate a higher return when it has a negative covariance and a lower return when it has a positive covariance. Right? So the asset that pays out when I'm hungry has a lower return. Why? Because the price is going to be higher. So think of, I'd have to, the price of this might be close to the price of half a meal. Right, now, something that gives me a free meal when I'm not hungry, I have an expected payout of half a meal, but it pays it out when I don't need it, so I'm probably not going to be willing to pay this expected value, but a lower price. So the expected payout is half a meal, but it probably only costs maybe 40% of the meal, which means it has a return of expected return of 10%, whereas this has an expected return of 0%. So assets with higher expected returns are reflecting their riskiness in the sense that they are likely to pay out when we don't need them. So we have to be given a premium in order for us to be willing to hold them. Right, so we can do this then, I think this covariance terms of just MR RE, it's the same calculation we have essentially here. Right, yeah, this is just more abstract or calculated. Right, so again, the discount factor is always telling us the marginal value of wealth, tomorrow versus the marginal value of wealth today, expressed in terms of today's utility. So we have this discount factor up here. Always, for me, at least intuitively, at least because I worked in a restaurant and I like to eat and I like to cook, but thinking about being hungry, it makes a lot of sense. And so, it's this covariance returns and the marginal value with marginal value of wealth. Right? So assets prefer, or investors prefer assets that pay off well in times of high hunger. And in that case, they're okay in equilibrium holding this asset even though its expected return is low. It might even be negative, right? The expected return, right? It's probably the expected return maybe of an insurance. If you buy insurance, You pay every month, right? And, you know, how much you're willing to pay, well, you know, is it likely that something's gonna happen? No. You calculate the expected, you know, average, you know, accident, likelihood of that, and the price, and even then, you're probably gonna be willing to pay more in insurance, because if that happens, if the accident happens, it's gonna happen all at once, in a situation where you're gonna need a lot of assistance. And you're willing to pay a very high premium for that, which means, right, you'd be willing to accept a very low return. Okay. So consumption-based asset pricing, this is the natural place for thinking about the relation of asset returns and macro. These expected excess returns are tied to consumption growth. If consumption is growing over time, that means in the future we expect to be less hungry than today. Right, this turns out to be, I can't argue with this thing, we see all the key components here from the model we were looking at yesterday. This is the consumption savings problem. Except now we're going to compare not just two periods, 1 and 2, but maybe an infinite set of periods. So between any two periods, we can write then with our period utility function, this marginal value of wealth, this stochastic discount factor, right, the covariance between the return on equity, and our discount factor. So if we use a popular utility function, so the power utility function, when gamma here is equal to 1, this is logarithmic utility, right? So the marginal utility is 1 over c. We can use, as gamma is larger, it's going to give us more strongly concave preferences. Right? This is a CRRA, constant relative risk aversion class of preferences. And we can now calculate then the expectation of the excess returns as gamma, this coefficient of risk aversion, times the covariance between the return and the risky return and consumption growth in this case. And so using then, as we saw up above, risk-free rate, the inverse of the risk-free rate is equal to the expectation of the discount factor, the average discount factor. This relates then our expected returns to then our risk-free rate and consumption. So what can we do here? We can now break these components apart. We have here our degree of relative risk aversion, and now this covariance we can break into, well, covariance is equal to the two standard deviations times their correlation. We can break this into this coefficient of relative risk aversion, the standard deviation of our risk standard deviation of our returns, standard deviation of consumption growth, and the correlation between the two. The reason why this is very useful is that correlation has to be between 0 or -1 and +1. If something has a correlation of 1, two of the objects have a correlation of 1, then they're moving completely in sync. If they have a correlation of -1, then they're moving exactly opposite. And if they have a correlation of 0, then they have nothing to do with each other. So there can be anything between -1 complete mirror images, 1 moving exactly together, or some amount in between. right? But this allows us then to reformulate this equality into an inequality. And we can now compare, say, the average returns on assets relative to their volatility to risk aversion and consumption growth. Or another way, wait a second, after the fact. Now let's look back over the past 20 years. We can see observe the ex post volatility of consumption growth, and compare the ex post average return with the ex post volatility of these returns. And this will tell us, right, give us a range or some bounds on what relative risk aversion needs to be. Right, and what we find is left-hand side, the Sharpe ratio. Right, so just as we see like a mean return on stocks over bonds, so this excess return is about 8%, and the standard deviation of that about 16%. So the Sharpe ratio, this left-hand side is about 0.5. Right. Sometimes it's a little bit lower for other countries or longer time series, but this number is usually at least like 0.2. Right, so if we take this 0.5 value, this tells us that 0.5 is less than gamma times signal, or relative risk aversion times consumption volatility has to be greater than 0.5. This is kind of a problem. We already know what people like to do with their consumption. Right? We don't want to have 30 coffees one day, and then no coffee for the rest of the month. We want to have a coffee every single day. We like very smooth consumption. We would expect then consumption growth to have a low volatility that's very smooth. And in the post-war data, we see the volatility in percentage of about 1.5 percentage points. So now, if we are going to satisfy this inequality with a Sharpe ratio of 0.5, volatility of consumption growth of 0.015, we would need risk aversion of 33, at least 33. This number is incredibly large. Incredibly large. If you look at experiments, micro experiments, we see numbers maybe in the 1 to 5 ratio. So actually, this is also a nice distribution. So relative risk aversion, right? Estimated models, it's all right around here. 1, 2, 3, 4, 5. We need a number at least this big. At least. At a bare minimum, it has to be. Whoa, we're pretty far off the data. very large, and it seems to be at odds with experimental data. All right, so maybe okay, so let's just say we have a gamma of 0.33. Maybe people are just more risk averse than they pretend to be during experiments. What turns out to happen then, we can now, from the same framework that we're using with our consumption savings model, we add in a risk-free. What does this mean for the risk-free rate? We can relate this to a rate of time preference, our expected consumption growth again, our coefficient risk aversion, and the variance of consumption growth. And when we put this in, the risk-free rate, we get these numbers. Okay, what does this mean? If we start off with a rate of time preference of 0, so beta is equal to 1, we would get that the risk-free rate is a 20% interest rate. That's what this risk aversion parameter is doing to us. We have an extremely high motive to smooth consumption, not just across states when it's risky, but also across time. Right? To get a interest rate that's risk-free interest rate is of 5%, so like roughly where we in the neighborhood. Right, we would need a discount rate of minus 15%. Right, so we would have to be, we're very risk averse, but we prefer the future compared to this. This is really confusing. Yeah? So this doesn't seem to be working so well. So what we've learned from this consumption-based model that we have, and we've been using, right, the qualitative components are there, but quantitative essentially around. The risk screen is just too large given sensible risk aversion parameters. Right? But what's very useful then for it is it's bringing together macroeconomics and financial analysis. Consumption is telling us everything we can know about the wealth and income prospects that people have that lead them to invest. Yeah? If we observe their consumption patterns, what they choose to consume, that's revealing their choices across time about investing, saving, and their valuation of wealth. Okay, so let's think about, I want to now discuss arbitrage versus speculation. Arbitrage would be different prices at different locations. It's a safe profit. So this was gold price in Ho Chi Minh City versus gold price in Bangkok. You can't lose. Speculation is an exploitation of expected temporal across time differences through short-term financial transactions. I believe the exchange rate is going to stay constant, which means if the interest rate goes up in Bhutan, I would like to sell my Vietnamese bonds and buy Bhutanese bonds. Now, that makes sense to adjust my portfolio towards Bhutanese bonds if their interest rate goes up relative to ours, if and only if it really turns out to be the case that the exchange rate doesn't change. Expectation, price differences across time. The future's uncertain. This is risky. What if exchange rates do change? Well, then my calculation won't work out. So as soon as we start exploiting differences across time, right? We have risk, simply because the future is unknown. Arbitrage would be doing things at one point in time, so you can make a safe, no-risk profit. So we can think of different ways to conduct arbitrage and speculation. Forward contracts, swaps, options, derivatives, etc. A lot of these financial instruments are useful in order to take advantage, to exploit, and then from a macro welfare perspective, to then close these arbitrage opportunities. You know, we would like, so for functioning financial markets, right? When markets don't function, we have market imperfections. Think of a stylized example of our credit constraints for consumers. This is going to affect people's decisions. Right? If they don't have access to credit markets, obviously, but if credit markets or financial markets aren't functioning properly, then they have access to them, but it's just not good, right? I mean, you know, if you don't have, then how useful is having a motorbike if it's broken? Right? You may as well not have a motorbike, right? If you have a broken motorbike, right? Having these financial instruments are, you know, is what allows us to find all of these arbitrage opportunities, potentially to close them. So an arbitrage is going to be direct sale and purchase of securities, even of these other instruments, but where all the positions are squared or closed out in one trading day. Yeah, so you can think of you could buy. Right? There could be a forward contract on Bhutanese Mongolia. Right? So I can buy we can think of interest rate here, interest rate in Bhutan minus then our expected appreciation. So if the interest rate is 2% in Vietnam and 3% in Bhutan, higher interest rate, this would be, if we were to take advantage of this, we have to speculate. Right? If I sell my bond in Vietnam, I'm giving up the 2%, I get dong, I buy Ngurian, I invest it at the 3%, and a year from now, so I have 3% more in Ngurian, and I buy back my dong. And I want to compare that total return with the 2% I could have gotten while just staying here. How can I avoid this speculation problem? What if I can buy, what if the cost of, so what was the exchange rate? So it was $300 Now, if minus so I don't know for certain what the exchange rate is going to be in a year, but there might be something called a forward contract where I could buy today, I could pay for delivery of dong in exchange for Nguyen in 1 year. I can conclude that contract today. So how about a forward contract? And if the forward contract is, say, it's 309 VND BTN in 1 year. Right, so now we can calculate the, I can sell my bond today, or I can buy this bond. I have to right, if it's, I'm just investing, let's invest 300, Vietnamese dong. So this would give me 1 BTN. Right. In a year, this would give me then 1.03 EGN in 1 year. And with the forward contract, I can buy guaranteed delivery for these 100. Let's see, 1 point math here. Let's do forward contract will only give me, that's right, 297 Vietnamese dong pro per Nguyen. So then from the 101.03 Nguyen in 1 year, I get then 306 Vietnamese dong in 1 year. And this contract is concluded today. I buy Nguyen today with my 300 dong. I buy the bond today. It's going to pay out in a year. And I buy the forward contract that's going to pay me the 306 dong for 1.03 in Nguyen in 1 year. So there's no more speculation. It's concluded right now. And now if you compare this, well, alternatively, invest in Vietnam, I would get 2%, which would be 306 VND. I could also conclude it here. So now we can, this is the threshold price of the forward contract, right? If it pays us less, right? So if we could conclude, I can look in the market, the futures market, what's the cost for delivery of dong in exchange for Nguyen in 1 year? And if that number is right less than that's 200, then I would make a loss, right? Doing this, engaging in this exchange, which means anywhere I can make a loss guaranteed, if I can do the operation in the opposite direction. How about I now, if I can short, right? Let's say I now sell my Nguyen, sell my bonds that I have in Bhutan today, invest in Vietnam, and translate the currency back to the forward contract, right? I could take advantage of that. So we'd expect then here these forward contracts to map out the differences here in the interest rates between the two. But if I engage so this is a risky investment. I'm going to wait and see what the exchange rate actually does. I'm promised by the Bhutanese government Nguyen in a year, and I'm hoping, I'm thinking, I believe, I'm wishing that the exchange rate will be in my favor. That's speculation. With a forward contract, I sign a contract. I've already promised away my Nguyen in a year today. I've promised them to someone else who's promised to give me 306 dong in 1 year. Right? Arbitrage is useful because it's going to ensure the same price across places. Right? So there's going to be the same gold price all across the country. Which also means if, with trading division markets, so let's say there's something that's scarce that we all need. Maybe after environment, let's think about oil. Right? Oil is a good classic example. If someone discovers a lot of oil, a new oil deposit that's found, the person who's discovered is going to profit from it, but we all will profit from it. Right? If it's a large oil discovery, right, this means there's going to be a larger quantity in the markets. As this larger quantity comes onto the market in, let's say, Dubai, people are going to be trading securities, and instantly, within nanoseconds, the price of oil in Osaka is going to go down because someone discovered oil in Saudi Arabia, right? That's what arbitrage is giving us, right? That's very useful. We all probably participate on a homogeneous good, right? In its scarcity or change there. Right now, there's some barriers, right? There's the moving gold. We thought from Bangkok to Ho Chi Minh is not a big deal, but moving. What's a big example? Like Cafe Sua. Going to trade Cafe Sua to Bhutan, that's a problem, right? That's transportation. Transporting that is difficult. There's also maybe transaction costs. Every time I want to sell something, right, I have to pay a fee, right? So we might have prices be a little bit different. right? The price of gold here might be a little bit higher than in Ho Chi Minh City. Why? Because there's lots of people in Ho Chi Minh City. There's lots going on, and there's less people here. Yeah? And yeah, so it's harder to get gold here. The airport isn't here. The harbor isn't here. Right? It takes resources to ship the gold up here. So there's some extra costs that have to be covered. And transaction costs, if I have gold here and I want money, right, there's simply because there's fewer people here, I'm less likely to sell it. Right?
The transaction is always the same.
No, yeah, it can be different. It's really going to be different. I think of, there's a transaction cost, like in terms of the direct cost that you might pay for at a bank, or if you think of changing your currency. But there's also, think of more intuitive, like transaction costs, like search and matching costs. If I'm in Ho Chi Minh City and I want to sell gold, that's very easy to do. I could find someone probably within 20 minutes to buy gold from me, I think. Now in Bangkok, if you want to sell gold, how quickly could you make that happen? Maybe not as quickly. I'm sure you could make it happen, but maybe not as quickly. And what if it's not a gram of gold? What if you have a kilogram of gold? How long would it take you to find someone in Bangkok who's going to buy a kilogram of gold from you? Might be difficult. In Ho Chi Minh City, I still bet that would happen pretty quickly. So we also have transaction costs in terms of time and effort. It takes more time and more effort, right, outside of financial centers. So that's how we can have a slightly higher gold price here in Bangkok than in Ho Chi Minh City, right? Because it's not worth your time. Sure, right? I could earn $1 per gram of gold if I brought it from Ho Chi Minh to Bangkok, but how much gold am I going to have to move to take advantage of this $1 difference per gram? Right? That's not worth my time, right? The $1 difference is right. So we can have arbitrage that isn't profitable between them. So we can have small price differences that aren't profitable because of transaction and transportation costs. But the information advantages that we get here, these are incredible. So we have arbitrage is going to right, if there's an excess. If the price is higher for a good than somewhere else, we're going to have large demand for the good where it's cheaper, right? And large excess supply, right, where it's too expensive. Right? This is going to shift then these quantities around, adjust the prices until these prices are roughly equated. Right. So this requires, of course, free capital markets. You have to be able to be allowed to move gold between Ho Chi Minh and Bangkok. You have to be able to move, if you want to sell the gold in Bhutan. I'm not sure how easy it is to go to Bhutan. If I show up at the airport, what do you have in your suitcase? Oh, nothing, it's just 100 kilograms of gold. They might want to talk to me. Right? Capital, markets, free capital movements, there's sometimes restrictions. Okay, but the result of arbitrage, liquid securities are traded around the world at nearly the same price. Right? So you can buy a stock in Google, in the company Google, at different markets at any point in time. And it's going to be at essentially the same price. Right, and this is really interesting when you think about it, like we have, there's a market open somewhere in the world at any point in time. So even when we go to sleep, there's another part of the world where people are trading. And because of, they have interest in all sorts of securities, they can be trading, Vietnamese coffee can be traded in the middle of the night in Vietnam, just at a different market. So all the markets here might be closed, but somewhere else in the world they might be trading securities and derivatives of these objects. So we get them, if they're liquid, if they can be traded, they'll be traded around the world at every time, and the price is going to be essentially uniform. Because if it's not, and it's a liquid asset, you can make arbitrage, you can make profit. and that's going to put massive pressure on prices. All right, so here I have another example. Let's say that a euro costs $1.58 in New York, but only $1.57 in London. Oh, price difference, right? We can make a profit, right? Well, transportation costs, they're none, I can just push a button, but transaction costs, every time I buy or sell money, right, I have to pay, let's say, a 5% fee. So let's think about the possibilities we could have. So the price is higher in New York than in London for a euro. So let's sell a euro for $1 in New York. So we're going to get more dollars for a euro in New York. Then we're going to take the dollar. Then we're going to sell the dollars for euros in London. So we start with dollars, end with dollars, and we do this just by pushing one button on our computer. Yeah? So in New York, we get, after the transaction costs, we get $1.57921. Right? 5% fees, so we don't get the 1.58, a little bit less. In London, right, we now sell it at the exchange rate 1.57, but we also have to pay the 0.05% transaction cost. Yeah, so it's not 5%, it's 0.05. Really small transaction. And when we do that, we come back and we now we've made half a cent profit. So these transaction costs ate up half the profits, but we still have half of a cent profit. It's just to see the size of this, right? We get an instant profit, risk-free, of about 5,000 euros per 1 million invested. Yeah? Right, and we can see the threshold here. The price deviation is 0.6%, and the cost here we have is 0.1%. We have an arbitrage profit that's possible. So you can now think of what happens if the transaction costs double, or if the transaction costs go up to 1%, for example, then you could run through this calculation and you'd make a loss. So these small transaction costs, right, but then if they're a little bit larger, they could sustain this price difference. Okay, so arbitrage is connecting different markets. This means the markets function as one single large market. And that's what I mean if you have this interconnection of markets around the globe, right? There's somewhere you can trade at any point in time. We have the markets trading 24/7. Any single market, right, there's days off, there's nighttime and the like, but somewhere in the globe we have markets trading, and through arbitrage they're all connected. It's as if we just had one global market. And so this should increase the efficiency. Right? If we have arbitrage, then the system's inefficient. Right? We have people that we have different prices in different markets, so we don't have one connected market. And which means we're not going to necessarily profit in Osaka from an oil discovery in Saudi Arabia. Okay, speculation is not exploitation of price differences at different markets, it's exploitation of price differences at different points in time. So there are two types of speculation. There's stabilizing speculation. This is going to reduce price differences. And there's destabilizing speculation. Right? Stabilizing speculation is actually a good thing. It's going to reduce price differences, increasing market efficiency. Leads to a positive profit for the speculator. Destabilizing speculation actually increases price differences, it reduces market efficiency, and should in the end lead to a negative profit for the speculator in the long run and average. So in terms of welfare, it's the effect on price differences that matters. So if we have stabilizing speculation, if we're reducing price differences, this is welfare increasing. So what would be an example? So think of if we there's a gas shortage coming. Right? Something bad happened in the Middle East, and we know there's not going to be oil export of the Middle East to Vietnam in 6 months or a period of 6 months after that. So we expect the price of oil in the future to go up relative to today. What could you do? What would speculation do that would be stabilized? Well, the price of oil in the future is going to go up relative to now. So if I buy oil now at this lower price and store it, in 6 months, I can sell it at the higher price. Right? I'll make a profit. So now, all of us, or a lot of people are going to do that. We're going to start buying oil today. What's that going to do to the oil price today? It's going to raise it. And then in the future, when we sell our oil in 6 months, there's lots of us selling the oil, so we're going to lower the future price. So we're leveling this price out. So in this sense, this is stabilizing speculation. We have an event that would tend to lead to a dramatic increase in price, and through this price difference, we can engage in a speculation, right? That would then spread this spike in prices across time.
Do we have negative
Yeah, so what would be an example of the destabilizing? Right. So destabilizing speculation. That's what we. So. I'll pick on Bitcoin for a second. Yeah. So. Why would you buy Bitcoin? So the only reason that anyone has ever given me for why they buy Bitcoin is they think the price is going to be higher in the future. I've not heard anyone give me a solid case for any other reason why they're going to buy Bitcoin other than they think the price is going to be higher in the future. Okay. So what we want is then, right? You want more people to buy Bitcoin as the future goes along, right? Pushing the price up in the future even higher. And their expectations higher. Right? So we're speculating on this price rising over time. Right? More people believing that is also going to push that price even higher. So the reason why this would lead to a negative profit for the speculator and the long-term expectations, if that's the only reason why it's going to go higher, is because we believe it's going to go higher and we keep buying it to go higher. Eventually, we run out of people, we run out of resources to buy Bitcoin. And then what happens? And then we have a negative profit for the speculator. And this speculating that the price is going to increase and keep increasing is what's pushing the price even further higher. It's a self-fulfilling expectation. Right? And it's destabilizing because it's continually increasing its price difference. And this is would be reducing market efficiency. So what you yeah. Okay, we've thought about interest rate parity when we looked at our open economy model yesterday. We can compare this to other parity methods. So we have the international purchasing power parity. So the law of one price. Does one good cost one good in different places? Right? Or do we have a Vietnamese basket of goods in exchange for US baskets of goods, right? How do we relate interest rates, exchange rates across countries? Is this arbitrage or speculation? Okay, so if we talk about purchasing power parity, right, we're going to be relating the exchange rate movements across time to price level changes. So essentially, you think if the price level in one country goes up, the exchange rate should move equivalently, right, to keep the same relative price before. We have absolute purchasing power parity, right, if the price level is the same when expressed in a common currency. So, let me see. And then I'll automatically see some examples of why it doesn't necessarily hold. So we're talking about, I was talking about, yeah, why don't we take a 10-minute break?
Yeah.
Yeah? And then we'll finish up. Good idea.